Dissecting 6 high-short interest stocks, bull and bear cases, technicals, fundamentals, and insider moves. Welcome to Short Squeeze Weekly, the show where we pull back the curtain on market action and hunt for both fireworks and traps among high-short interest stocks. I'm your host, Sam, bringing you market analysis for real traders, investors, and curious listeners. Whether you're squeezing out alpha, dodging landmines, or just fine-tuning your watch list. Today, we're serving up deep dive breakdowns of 6 potential short squeeze candidates that have been lighting up the screens. PDGX, Protagonist Therapeutics, USAR, USA Rare Earth, ASBN, Aspen Aerogels, CDXS, Codexis, GLUE, Monte Rosa Therapeutics, and CATX, Perspective Therapeutics. We'll break down the bull and bear cases for each, digging into technical analysis, quant signals, fundamental drivers, and even the latest insider trading action. My goal: help you unravel what's fueling the price action, what could go wrong, and what we're watching next. So grab your coffee or your notepad, and let's squeeze some insight out of this week's market stories. Segment 1. The anatomy of a short squeeze, setting the scene. Before we tackle the tickers, let's clarify what makes a short squeeze setup so electrifying and treacherous. Short squeezes occur when traders betting against a stock start to get nervous and rush to cover their positions, typically after a positive catalyst or rapid price spike. The irony? The very act of covering short positions by frantic buying can supercharge an already volatile move, sending prices even higher for a short but dramatic window. High short interest, low float, and a looming catalyst. That's the recipe. But, as experienced traders know, squeezing the shorts is risky business. When a spike fizzles, prices can drop as quickly as they rose. We'll be using technical signals, short interest ratios, institutional behavior, fundamental analysis, and insider transaction data to break down just how much squeeze juice is left in each name. Segment 2. Protagonist Therapeutics, PGX, momentous moves in biotech. First up, PGX, Protagonist Therapeutics, a biotech name making major market waves. Technical analysis. Recent action in PGX has been jaw-dropping. Shares surged over 32% in a single session, peaking at $93.25, before some profit-taking brought it back around $80 to $87. The stock's 52-week range is $33.31 to $93.25, with a 5-day gain of 1.54% and a 1-month pop of 13.56%. Momentum remains exceptional, and the 1-year return stands at over 50%. The Relative Strength Index, RSI, has bordered on overbought during price spikes, reflecting feverish demand. Notably, volume during the surge was several times the daily average. Classic short squeeze fuel. The technical indicators show a strong uptrend, but chartists should be wary of the increasing volatility. Parabolic run-ups are often followed by sharp retracements. Quantitative short squeeze signals. PGX has been a repeat visitor to short squeeze screens. The latest data shows significant short interest, amplified by heavy trading volumes. While the company's short float isn't published daily, spikes in volume after news events, particularly clinical results and deal speculation, hint at shorts rushing for the exits. A recent squeeze was triggered by bullish clinical trial results and rumors of acquisition talks with industry giant Johnson & Johnson, underscoring how quickly sentiment can flip. With an elevated beta of 2.20, PGX exhibits outsized swings relative to the S&P 500, a hallmark of squeeze-prone names. Rapid rallies on news tend to trap bearish traders in a buying panic. Fundamental analysis. PDGX stands out for its underlying momentum. Annual revenues recently hit a stunning $434.4 million, with a 3-year compound annual growth rate north of 65%. The flagship product, Icotrokinra, has demonstrated strong Phase 3 data for psoriasis, a market with compelling global potential. Ongoing EMA review adds to the bullish case, as does a robust pipeline targeting hematology and autoimmune disorders. Several strategic collaborations with big names like Johnson & Johnson and Takeda enhance credibility and commercial prospects. Balance sheet strengths include current ratio of 17, reflecting ample liquidity. Very low debt-to-equity ratio, 0.02, meaning minimal leverage risk. Asset turnover at 0.3 and solid operational leverage. However, bear spotlight. A high-priced earnings ratio, over 89, and a price/book over 6 suggest a premium is already priced in. Recent net losses. Q2 2025 saw a net loss of $34.77 million, and free cash flow is negative $29.59 million, indicating cash burn is still a concern despite high revenue. Valuation is stretched for a company with net losses, and where positive net income is still not consistently established. The company's story revolves around future promise more than current profitability, a dynamic seen in many biotech high flyers. Insider activity. Recent filings indicate 5 purchases and 4 open market sales over the last year, with insiders net buying 52,584 shares in total. CEO Dinesh V. Patel holds a significant chunk, but no massive insider moves have been recorded in recent quarters, suggesting management has neither aggressively sold into strength nor bet the house on further upside. PEGX bull case. Proponents see PEGX as a biotech leader ready for mainstream validation. Strong clinical data positions icotrokinra as a next-generation therapeutic for major autoimmune conditions. Respected partners, J&J, Takeda, de-risk commercialization and validate the science. Balance sheet strength and liquidity shield the company during the final leg of clinical trials and regulatory review. Current short interest leaves room for further covering, especially if EMA approval or an M&A deal materializes. PDGX bear case. Bearish analysts and traders warn. Much of the good news appears to be priced in. Current PE and PEB multiples are hard to justify without rapid profitability. Net losses and cash burn are persistent. Negative cash flow and ongoing R&D investment could force capital raises at unfavorable terms in a volatile biotech market. If EMA delays or denies approval, or if acquisition talks with J&J fizzle, downside risk is meaningful. Parabolic moves often unwind, especially if short-term traders lose their nerve. Segment 3. USA Rare Earth, USAR. Supply chain politics meets squeeze dynamics. Next, we're jumping from biotech to a critical minerals high flyer. USAR, USA Rare Earth. This is a story where policy, geopolitics, and supply chain anxiety drive both the bull and bear debates. Technical analysis. USAR has been in rally mode throughout 2025, with shares leaping from the low teens to recent highs near $26 to $32, up as much as 140% year-to-date. The uptrend intensified after reports surfaced about high-level White House talks, causing multiple one-day spikes, some exceeding 18%, and trading volume to balloon well above historical norms. The stock has since demonstrated high volatility, with sharp pullbacks following disappointing earnings or competitor announcements. Chart analysis also points to classic squeeze signatures. USAR's price is consistently above major moving averages, but its RSI indicates overbought territory. The technical setup is classic for a high beta, low float squeeze play, but wild swings in both directions demand sturdy nerves. Quantitative short squeeze signals. Short interest recently stood at 9.62% of float, a meaningful level for a mid-cap name, with a days-to-cover ratio of just 1.3. The rapid rise in both price and short volume suggests a squeeze may already have played out. Some of the juice may be gone, but the potential for new squeezes remains given how tightly the stock is held, 46% insider ownership, and the continuous news cycle. A key data point. Institutional short sellers in the most recent months have included heavy hitters like Jane Street and Walleye Capital. Fundamental analysis. USAR is the quintessential story-driven stock. It's a critical player as the U.S. rushes to rebuild domestic rare earth supply chains in the context of U.S.-China tensions and federal policy action. Highlights include vertical integration. USAR is developing the Round Top mine, Texas, building a magnet factory in Oklahoma, set for 2026, and just acquired Less Common Metals in the UK for $100 million plus equity, creating a mine-to-magnet closed loop. Strong cash reserves pre-acquisition. Over $120 million cash as of August 2025, now drawn down for acquisitions. Minimal debt. No commercial revenue yet. All growth is in development. Net loss widened to $142.7 million in Q2, and there's an explicit going concern warning in filings. USAR's commercial upside is built on securing long-term customer contracts. Currently, 12 MOUs and JDAs have been signed, and management claims there's active dialogue with over 70 potential clients. The company is also a direct beneficiary of recent U.S. government maneuvers, supply chain grants, the Defense Production Act, and the possibility of federal equity investment akin to MP Materials and Lithium Americas. Bear points. Execution risk is sky-high. Delays, technical missteps, or overruns can torpedo the bull thesis. USAR has no revenues and heavy cash burn, so more capital raises are likely if government support is slow to materialize. Insider activity. Insider turnover has been relatively light, but notable. In August 2025, Director Michael Blitzer sold over 2 million shares, about $33 million. A significant move given that insiders still own nearly 47% of the company. No reported insider buying in the past 12 months, but one large sell indicates that even insiders are cashing in on recent strength. USAR bull case. USAR is at the heart of urgent U.S. supply chain policy. If federal investment comes through, the upside could be immense. Market demand for rare earth magnets is set to skyrocket. EVs, wind turbines, defense, AI robotics, and China's export restrictions create urgency for domestic suppliers. Vertical integration and blue-chip management. Ex-Siemens USA CEO, as new CEO, offer competitive advantage. Any news of government investment, customer contracts, or early production success could reignite a new squeeze. USAR bear case. No revenues, mounting losses, and a going concern warning. If policy support is slow or diluted, financial distress looms. Execution risks abound. Building complex rare earth mines and factories rarely goes to plan. Recent director selling suggests others may be looking to lock in gains after the squeeze-driven rally. If government support disappoints, or competitors like MP Materials or Linus, win all the big contracts, downside is swift. Segment transition. Next up, high-tech insulation and battery innovation. Can Aspen Aerogels keep the short sweating? Segment 4. Aspen Aerogels, ESPN. Electrifying insulation, electrifying volatility. Technical analysis. ASPN is classic short squeeze territory. At latest check, the stock was trading just north of $8. After a 7.56% gain in a single day, its price swinging between $5.19 and $12.70 over the past year. Over the last 18 months, ASPN has shown several hard spikes followed by drawn-out slides, textbook squeeze, and retrace behavior. Short interest is quite high, 9.12 million shares, or just over 11% of outstanding shares. The days-to-cover ratio sits at 4.5, and there's regular evidence of trading volume spiking to more than 150% of the daily average. Trades often seen just before or during squeezes. ASPN's chart shows an uptrend resuming off the summer 2025 lows, supported by a base above the 200-day moving average. The next technical resistance is near $9, and again at the $12 range if a breakout accelerates. Quantitative short squeeze signals. Traders are watching ASPN for more than just the high short interest. Notables include short interest decreased slightly in September, but at 11% plus it's still elevated and vulnerable to a squeeze. The short interest ratio of 4.5 is moderately high, and institutional shorts remain active. Jane Street, Group 1 Trading, Walleye Capital. Average trading volume is rising, suggesting that both short sellers and momentum traders are active. Fundamental analysis. Aspen Aerogels is positioned at the nexus of the green energy transition and EV boom. It makes ultra-light, high-performance aerogel insulation critical for electric vehicle, EV battery packs. Pyro-thin thermal barriers are used by major automakers, GM, Toyota, Scania, Audi, Volvo, and others. Industrial energy applications. Aspen's energy insulation is used by big oil, refiners, and petrochemical giants. Strong recent growth. Revenues soared to $452.7 million in 2024 from $238.7 million in 2023, and orders for its thermal barriers, especially pyro-thin, have ballooned as EV adoption rises. GM was 64% of revenue in 2024, with strong international growth ambitions. Bearish angles. Heavy customer concentration. GM is by far the biggest buyer. Cost pressures remain. Margins have improved, but ASPN still isn't reliably profitable, and capital expenditures are heavy as it builds new capacity. Court battles to enforce patents overseas, while a moat, are also a drain on management resources. Insider activity. Insider activity is mixed. Over the last 12 months, CEO Donald Young purchased $107,000 worth of shares, $20,000 at $5.35, while Chief Accounting Officer Santhosh Daniel sold about $47,000 across 2 transactions in August. However, over the last 24 months, total insider buying, 20,000 shares at $107,000, is dwarfed by much greater aggregate insider selling, $94.6 million, albeit much of that likely relates to planned selling and older grants. Insider ownership as of the last update stands at about 4.3%, suggesting that while the leadership retains a position, much ownership has shifted over time. SBN bull case. Electrification tailwinds, with adoption of EVs and grid storage, should propel revenue and help Aspen diversify away from its industrial base. Ongoing patent victories and settlements reduce competition and protect margin. Short interest is still high, and surprise earnings or a new major contract could spark another squeeze. SBN bear case. Heavy reliance on a handful of customers, notably GM, creates risk. Any contract loss dramatically impacts revenue. Margins are improving, but fierce price competition and development costs remain a challenge. Insider sales outweigh purchases by a factor of nearly 900 to 1 in dollar terms, and the crowded short book can unwind quickly if sentiment sours. Segment 5. Codexis, CDXS, Precision Enzymes, Precision Trading. Technical analysis. Codexis has weathered a dour year. Shares are down by over 18% year-on-year, but have rebounded recently, gaining 4.53% over the past week and 2.42% in the last month. The prices range between $1.90 and $6.08, showing a classic pattern where disappointment is met with volatile but low-volume rallies. Technical signals are mixed. The chart shows recent consolidation just above $2.50 support, with new resistance at $2.75 and $3. A volume spike to 2.5 times average late August suggests interest from institutions or hedge funds triggered by news or a technical pivot. Short interest has surged, now at 5.63 million shares, 6.24%, with a high days-to-cover ratio of 5.6, meaning any upward price action could trigger a squeeze, but also suggesting shorts are stubborn. Quantitative short squeeze signals. While CDXS's short interest lags the very highest shorted names, the combination of a relatively illiquid float and rising days-to-cover ratio means it remains a candidate for a squeeze in the right conditions. Bearish sentiment dominates. Only 37% of days have been green over the last month, and volatility has averaged 5 to 6% daily. Institutional ownership is high, suggesting institutions are hedging both ways. Fundamental analysis. Codexis is an under-the-radar leader in protein and enzyme engineering, with applications ranging from pharmaceutical synthesis to food technology. Revenue. Q2 revenue beat expectations, hitting $15.3 million, and product gross margin jumped to 72% as high-margin biocatalyst orders increased. Balance sheet. $66.3 million in cash and equivalents as of June, with targeted capital raises backing investment in its ECO synthesis RNA manufacturing platform. Growth pipeline. Over 30 active commercial engagements for new enzyme technologies, with significant interest at major industry conferences. Customer base, still concentrated in a handful of key agreements. Expansion is underway, but product mix is evolving. Losses are narrowing. The net loss for Q2 was $13.3 million, a marked improvement over $22.8 million in Q2 2024. Still, the firm remains unprofitable, and product cycles are lumpy. Insider activity. Insider transactions reveal conviction by outside investors. The most prominent is Opali Management, a greater than 10% owner, which has scooped up millions of shares on the open market throughout 2025 at prices between $1.98 and $4.70. Inside the C-suite, CEO, COO, and several directors have purchased meaningful but smaller lots in late 2023 and early 2024. Conversely, only minor selling has been recorded over the last 2 years. CDXS bull case. Codexis is quietly carving out a key role in biotech manufacturing, especially with its ECO synthesis enzyme platform for RNAi therapeutics, a hot area for pharma. Recent revenue growth and margins signal a more efficient business model emerging. Heavy insider/institutional buying, especially Opali's large stake, suggests smart money bets. High short interest and improving operations could combine for a squeeze if news or earnings surprise. CDXS bear case. Business performance remains choppy. Revenue jumps are tied to lumpy contract wins, while losses, though narrowing, are ongoing. Short sellers point to relatively weak guidance, lack of recurring revenue, and a need for further capital raises if biotech sentiment sours. With low analyst coverage and little media hype, upside could be slow unless a major new contract or partnership lands. From enzymes to molecular glues, Monte Rosa Therapeutics is up next, one of the most heavily shorted stocks in biotech today. Segment 6. Monte Rosa Therapeutics, GLUE. Squeeze by name, squeeze by nature. Technical analysis. GLUE has become a poster child for short squeeze hunters, closing recently at $4.81, then surging by a stunning 64.91% in extended trading to $7.93 after key events. The chart shows a long stretch of heavy selling pressure, followed by abrupt reversals and monster volume. Over the past year, prices range between $3.87 and $10.36, with several sharp rallies and equally dramatic reversals. Short interest is a staggering 17.84% of float, among the highest in its peer group, with a days-to-cover ratio over 20, far exceeding the danger zone for potential squeeze risk. In August, short interest decreased slightly, but only from extraordinary heights. Quantitative short squeeze signals. GLUE's short squeeze setup is textbook. Heavy short interest, 8.24 million shares, a low float, and episodic price surges are all in place. The extended trading jump to nearly $8 came on the heels of strong clinical progress and new collaboration revenue. This type of after-hours move is often a sign of panicked short covering. GLUE short interest also dwarfs many peers, outpacing companies like Trevi, Structure and Enliven by a wide margin. Trading volumes nearing 100% of the daily average during major spikes confirm a tug-of-war between buyers and short sellers. Fundamental analysis. Monte Rosa is at the cutting edge of molecular glue degrader therapies, with several assets advancing in clinical and preclinical programs. Lead programs: MRT 6160, immune-mediated disease, partnered with Novartis, up to $2.1 billion in milestones. MRT 2359, solid tumors, and MRT 8102, inflammatory CNS disorders. Recent wins: positive phase 1 results for MRT 6160, expanded collaboration with Novartis, and strong preclinical data for next-gen cancer targets. Financials: Q1 2025 net income totaled $46.9 million, after recognizing $85 million in collaboration revenue. Without it, the company remains loss-making, and cash reserves exceed $300 million. R&D spend is a sizable $32 million a quarter, as expected for a deep pipeline biotech. Bear highlights. Monte Rosa is pre-revenue for product sales. The balance sheet is strong thanks to collaborations, but clinical and regulatory risk remain high. Frequent need to raise capital could dilute existing holders if collaborative payments ebb. Insider activity. Insider purchases have been modest. Director Chandra P. Leo bought 10,000 shares at $5.84 in March 2025, while Officer Edmund Dunn sold small tranches in June, about $9,000 at $4.45. However, the most notable selling came from Versant Venture Capital, a major early backer, which unloaded over 1.5 million shares late last year around $6 to $10 per share. Overall, insider ownership stands at 6.5%, and most recent transactions are neutral to slightly positive, with some directors betting opportunistically on price weakness. GLUE bull case. Molecular glue degrader therapies are a fast-growing area in biotech, drawing heavy big pharma investment. Landmark deals with Novartis, potential for billions in milestones, and strong clinical progress enhance the risk-reward. Elevated short interest and low float heighten the chance of further squeezes on positive news. GLUE bear case. Development stage, status. Everything hinges on new clinical readouts and regulatory progress. A recent extended trading spikes may have already flushed out some shorts, limiting near-term squeeze potential, unless fresh news arrives. Heavy insider selling by legacy VC backers could weigh on sentiment. Segment 9. Key takeaways and actionable insights. Post recaps with energy. PGX and GLUE are classic biotech squeeze magnets. Crazy price action, high short interest, and event-driven nature. If you play these, know your exit before you enter. UZAR is the poster child for the intersection of politics, policy, and speculation. It's a bet the thesis, not the clock type of story. Huge potential, but wider risk. ASBN and CDXS are stealth candidates, renewable, EV, and biotech themes, with high short interest in recent insider/institutional buying. Surprise news could trigger new squeezes, while weak guidance could see them drift or drop. CATX stands out for robust insider conviction and provocative product potential. It remains a favorite among sophisticated Insi buyers. But make no mistake, every stock we covered is high risk, high volatility, and do your homework territory. That wraps up this deep dive episode of Short Squeeze Daily. If you found today's insights useful, please subscribe, leave a rating, and share your favorite moments on social.